The tax law was changed for a variety of different reasons, right? And so there are a couple different reasons as to why they made this. One of the reasons that they came up with these laws, these changes, was because they wanted to simplify the tax code. Okay, so the reality is, did they simplify the tax code? And they try to do this, every so often. And it's a really difficult thing to do. It's like balancing a budget or anything else. So I think in certain ways they did simplify it. And in other ways, they made it a little bit more complicated, right? So they take it and give it and everything else. And then obviously it was to stimulate growth in the economy. And I think there have been things that have been put in place to do just that. And as you get into taxes and law changes and so forth, my goal here is not to share political views or anything like that. This is the reality, this is the law, whether you like it or not. But to give you things to think about for your own situation. And as we go through this, taxes, just like investments, everything is really personal and specific to you. So obviously, I'm going to cover as much as I possibly can throughout this presentation. So we'll start at the federal level for individuals. There was talk about, there's 7 tax brackets. There was talk about making this go to 3. I think that would simplify things. That didn't come through. But the reality is there were some minor changes in the federal tax brackets. And I think on average, most taxpayers should experience between a decrease in tax between about 1%, maybe even up to 2%, depending upon what bracket you fall into. The top tax bracket is no longer almost 40%, right? It's about 37%. So there have been some benefits from that perspective. If you look at the standard deduction, just to take people back, because I don't expect everyone to truly understand taxes. It's not the sexiest topic. But when you think about it, obviously you can either take the standard deduction or you can itemize. And so what happened here is they said, most people take the standard deduction. I'm not suggesting most people in this room, but most taxpayers across the country will take the standard deduction. It's about 75%. After this new tax law, it's going to be about, experts would say, almost 90% of people will take the standard deduction. Because they've actually doubled the amount of standard deduction that you can now take going forward in 2018. So the reality is, when it comes to itemizing, most people are not going to itemize their taxes. And so they said this simplifies things. It makes things easier. People are going to save a lot in taxes. Well, while they did do that, which does create gains for certain people and positives, they took away the personal exemptions. So if you have children and so forth, and it's just north of $4,000 a piece. So again, they gave you the benefit of increasing the standard deduction, but they took away personal exemptions. And people like to talk about winners and losers in this tax law. I'm going to try and stay away from that. But one thing to think about is, if I was taking the standard deduction and I have 4, maybe 3, 4, 5 kids, and I was getting all these personal exemptions, the reality is, again, simplifying things, I'm actually going to pay more in taxes. I would have rather kept the standard deduction low and increased my personal exemptions. Okay, so I know the nightly news likes to say, depending upon what channel you watch, this is really bad or this is really good. Everyone's situation is going to be a little bit different. But that's what's taking place from this perspective. There was something called the P's limitation. So when you did itemize, or if you continue to itemize, there was a governor they put in place. There was a limitation. And what they said was that if you are itemizing and you make in excess of Y, you're not going to be able to take all of the itemized deductions. This is the way the law has been written for years, by the way. And so they said, look, we're going to get rid of the P's limitation. So if you're an individual that's going to continue to itemize, this is a really positive thing for you because you no longer have that cap. So that's nice. But then again, they took away miscellaneous itemized deductions. This could be tax preparation fee, advisory fees. This could be hobby losses. There's a slew of what are known as miscellaneous itemized deductions, and they took these away. You have AMT, real simply. AMT is an alternative minimum tax. That is essentially a tax that was put in place years ago. You had the real wealthy invest in tax-free investments, and they got away with paying their share of taxes. They put AMT in place to sort of curtail that to some degree. The reality is, 40 years later, some people are paying AMT that should never have been involved with AMT or subject to AMT. So there's an exemption. They continue to increase that exemption. It's higher than it's ever been. That's positive. Also note, all these changes that I'm referring to, they will expire, they will sunset at the end of 2025. And just a note about that too, and I think we're all aware of this, I have a chart here that's going to show what is going to be temporary versus what's permanent. In tax law, everything's temporary. It just depends on who's in power, right? So it's just something to think about. All of these things can and candidly will change. So investments, a few things that haven't changed. Qualified dividends, we still have those. Yay. We have the 3%, the 3% net investment income. That was Obama's Obamacare, if you will. That is still in place. That's something we pay tax on. And if you make an excess of Y, you're going to pay that Medicare. Actually, it's going to be, there is no cap on the 0.9% Medicare, similar to Social Security. That was to aid in Social Security. Again, that was put in place by President Obama a couple of years ago. So those two things have not changed. Section 1031, I hate to use tax code sections with you, but this is just the best way to explain it. There's something called a like-kind exchange. So if you have investment property, you're in business and so forth, the idea that there's flexibility in the tax code that you can swap one thing for another and defer the tax gain on that. So for example, you may have farmland, you may have cattle, you can swap cattle for cattle, or you can swap, a cow for a chicken, and you wouldn't have to pay tax on that. However that works, I'm not in the farming community, I'm not tied to that. I'm trying here. But real estate-wise too, if you had a strip mall, you can exchange that for maybe some other form of rental property. It was really lax in terms of what was defined as like kind. Well, today they eliminated most of that, and they just said now it's strictly to real estate. So one last thing about this, if you're a real estate investor, if you have real estate and so forth, again, this is not your primary residence, this is for investment use, and you're thinking about selling that, or you want to unwind that in some way, you can, again, swap one property for another property, not pay current tax on it today, you actually defer that gain. And a really neat loophole is there's no cap on that, so you can continue to roll one property for another property for another property. There's a strategy, it's hate saying it, but it's roll and die. You continue to roll and roll and roll and roll until you pass, and your kids inherit that, and there's tax benefits on doing so. From an income perspective, there really is no tax to pay because you get a step up in death. So anyway, having said that, so it's an interesting strategy that is still available. There are several loopholes that are still out there. So important things to consider if you're in that space. So mortgage interest, there's a lot of talk about this. So the best way to think about this is, and I wouldn't even look at the chart, but the best thing to think about is, last year and years prior, you could deduct up to $1 million worth of mortgage interest. Okay, so if you have a house today and you have a mortgage, you can still deduct up to $1 million, even grandfathered. Now, for those individuals that are going out and they're getting new debt, well, there is a limitation on how much you can deduct, and it's up to the $750,000. That's really what you want to pay attention to. For most people, it's not going to impact them. Again, when we look around the country, most people aren't having a mortgage of $1 million. Okay, 750, again, depends on maybe where you live and what that looks like. So those are things to think about. The important piece of this, which is leading to some confusion as well, is a line of credit or a HELOC. And so, you may today, or in years past, you go buy a car and you want to borrow to finance that car. You may have worked with the dealer themselves, or somebody said to you, you know what, why don't you take out a line of credit because it's tax deductible. And that way you have a great interest rate, depending upon what interest rates are, but you're able to deduct that. Well, today you're not able to deduct that. So if someone was going to the dealer today, they ask you how they're going to finance that, you may very well finance that through the dealer today because you no longer have the ability to deduct up to the $100,000 that you used to in that example. It all depends on what the use is of that HELOC or that line of credit. So if you're using it to substantially improve your house, you can still deduct up to that $100,000. But for these other things, like buying a car or something that's not tied to substantially improving your home, that is no longer deductible. So those are things that you want to think about. State and local taxes, which is referred to as SALT. You may have heard of this. It actually includes a lot more than just state and local taxes. You think about real estate taxes, you think about property taxes. You're now capped up to $10,000. So if you just sat back and mentally said, what do you pay in real estate? What do you pay in mortgage interest? What do you pay in some of these deductions? You may be in excess of 10, and you're saying to yourself, well, what do I do now? Candidly, there's not a whole lot you can do now. We live in the Kansas City area. So for us, to some degree, I would say taxes are relatively, you're not going to pay as high, if you will, as you look at the coast. And so if you look at some of these, you have the West Coast, you have the East Coast. I would tell you, being from the East Coast, for a house like the one around the corner, you're probably looking at about 25 to 35 in property taxes alone. So, when we look here, this area, the Kansas City area, is not getting hit the most, but we are getting hit just like everybody else. So trying to keep things in perspective. And this is going to expire in at the end of 2025 as well. The impact on medical and charitable. So it used to be you had to have an excess of, you could deduct up to 10% of your AGI. Once you cleared that threshold, 10% of your AGI, you were able to deduct medical expenses. So what they did is they lowered it. Again, another positive. So now it's at 7.5%. So that threshold to hit that is going to be less, which is, again, terrific. It's only going to be for a couple of years. And there's a chart on this, and I'll show you this. Again, assuming that this stays in place. Then you have cash contributions of charity. So we always say if we give to charity, we get to deduct it. It's a little bit more complicated than that. It depends on who you're giving those assets to, what institution. Is it a church? Is it a private foundation? The deductibility is different. What am I giving? Am I giving stock or appreciated asset of some sort, or am I giving cash? There's all different limitations. But keeping things simple, you used to be able to deduct up to 50% of your AGI, your adjusted gross income, when you make a cash contribution to a charitable organization. They've now made it 60%. And I think there's some benefits there, especially if you look at your adjusted gross income to the amount of charitable contributions that you have. So there may be 1 year where you've done really, really well. It'll increase your AGI and so forth, your ability to, your deduction ability. Also for retirees, that maybe their income and what they're bringing in is less than it has been in previous years when they were working. Now you have the ability to deduct up to 60%. So I think there are advantages to that. I think that's a real positive. There's some thought about what impact is this going to have with charity? What impact is the tax law going to have on charitable contributions? So I know there are a lot of people that are out there that are saying this is going to kill charitable contributions because, again, that's an itemized deduction. And if most people are taking the standard deduction, charity is going to suffer. It depends on what you believe. I truly believe that people are passionate about causes. And in general, people want to give back and support. So I don't think this is going to crush charities. Having said that, I would tell you that if you are taking the standard deduction, there are things that you can do to bunch your deductions. This goes for charitable or medical. It's probably more difficult to bunch your medical deductions depending upon your situation. Excuse me. But to give you an example, if you were to give $20,000 to the church in 1 year, and you do that actually every year going forward, you may not hit that threshold to take the itemized deductions, and therefore you're not getting a deduction for that charitable contribution. So just from simply a tax play, you may say to yourself, you know what, I'm going to do every other year, I'll do $40,000. And that will give me enough of a contribution, potentially, and enough excess to now itemize for the year. I'll be able to take a greater deduction, so I'll lower my taxes, and maybe I'll give more money to the church, in my example, in that first year, which is advantageous to them. So there's different things to think about. I don't think this will crush charitable contributions. I just think from a planning perspective, it gives you a few more things to think about or a couple of hours in your quiver. What about the kids? So there's a child tax credit up to $2,000. It phases out for couples that are making $400,000 or $200,000 if you're single. There's also a $500 credit that's available, for a non-child dependent. So think about maybe taking care of your parents or another loved one. I think that's, of course, advantageous. Two things to think about. When we talk about credits and deductions, I think people get confused. A credit is a dollar for dollar reduction. It's not a deduction. I shouldn't even say that word. It's a credit. So if you owe $500 in taxes and you have a $500 credit, you pay $0 in taxes, right? I mean, it's much better than simply a deduction. 529 accounts, 529 savings accounts. Again, this comes from the section of the tax code. These are college savings plans that I think a lot of people know about. A lot of advantages to them. One of the changes that was made in the tax law is now it's not just for higher education. It's actually K through 12. You can use it for private school as well, which is really powerful. So that's something that's a big change that was made. You can do it for homeschooling as well. And just real basic background on this. You put the money into these 529 plans, they grow tax-free if they're used for, again, education. And depending upon which plan you use, both Kansas and Missouri, for that matter, both have a state tax deduction if you invest in that plan. A lot of benefits to it, a lot of different advantages to it. I know we don't have the time to get into all of them. But something else that's in the news a lot recently, so I thought I'd hit this. And there's a note in the tax bill on it. It's not 529 savings plans. They're called 529s. They're ABLE accounts, Achieving a Better Life Experience Act. So for those of you that know someone or have a relationship with someone that is disabled, you may have heard of a special needs trust. Those are incredibly valuable. This is not a special needs trust. but it is the ability to invest in an account that grows tax-free, and it can be used for the benefit of that individual who is disabled. And it doesn't count against them for state aid and what have you. These accounts are incredibly new. They came out just a couple of years ago. They're not available in every state, but even if you live in a state in which they don't provide one, you can use another state's plan. Again, they're very new. There's a lot of detail around this. I'm happy to take questions on it afterwards. And then kitty tax. So years ago, many years ago, people would invest in their kid's name because their children are going to be in a lower income tax bracket. So they came out with something called kitty tax years ago. And they said that they were trying to curtail this, obviously. And so once you hit a certain threshold, you'd be taxed at the parent's rate. Again, this is all for unearned income. Well, today, they've even curtailed that a little bit more. And they said if you invest in your kid's name, once you, kids that are under 18, once you clear that $2,100 threshold, you're actually going to be taxed at trust rates. That's a bad thing. Trust rates get to the top tax bracket of now 37% once you clear about $12,500. So in general, it's not a good idea to invest in your kid's name from that perspective. Again, simply from the tax perspective, you better off keeping it in your own name. You love life. So nobody wants to get divorced, and nobody wants to pay alimony if that happens. But all kidding aside, alimony is no longer deductible. This was a huge deduction if you were paying it. You no longer have that. So you are paying likely substantially more in taxes if you're paying alimony. So that's something that's been stopped. The marriage penalty relief, the best way to describe this, I think, in real simplistic terms, because this is, again, something that's talked about in the nightly news. If you were single and you made $100,000 a year, you're going to pay X tax bracket. If you're married and you have $200,000 a year, if things were perfectly aligned, you pay exactly what that single person paid. You fall into that same similar tax bracket. So the reality is you don't. That's just not the way it's set up. It's not set up completely vertical like that. So if you're married, you're actually going to pay a little bit higher. That's called the marriage penalty. They've effectively eliminated the marriage penalty. So it's more in line, which is great, until you're making above about $600,000, and then it changes a bit. So it's great to see that there's relief from that perspective. Estate and gift. Today I would tell you that most people, even last year, weren't subject to estate tax. Right? You'd have to have over a substantial amount of money. Today that's about $1 million. It's about double that. It's about 22 if you're married. So again, at the end of your life, and you're passing assets as it relates to gift and estate taxes. If you had assets in excess of this, you may owe estate tax unless you've done the proper planning and what have you. So this really isn't an issue anymore for most people. You're able to give $15,000 a year this year to anybody. If you're married, you can double that. It's called gift splitting. You can give up to $30,000. So technically, I can give up to $30,000 to every single person in this room if I had it. That's exactly how it's done. But having said that, you have the ability to do that, so that's advantageous. So again, for most people, estate tax is not a huge issue. But for those of you that it is an issue, the reality is, in my opinion, you have another 8 years in 2025 to really take advantage of what that looks like today. So I mean by that, I'm suggesting that these numbers are going to revert back. Things are going to change. I wouldn't be surprised if the estate tax comes back in a much different fashion, and much more people are subject to it. I believe that's my guess on what's going to happen over the next 10 years personally. But to be able to take advantage of that today, I think you have a small window of opportunity, so I think that's excellent. The real point I want to hit is while most people aren't subject to estate tax and estate planning are two very different things. I am not subject to estate tax. Never was, may never be. I have need for estate planning, like you would believe. I have kids. I have a wife that I want to make sure is taken care of. I have family that I want to make sure is taken care of. I want to be able to control things from the grave. I want to make sure that even if I'm no longer around, things are in place. That's estate planning. Having all the documents in place, having a trust in place, having the right insurance levels in place, having everything titled, it's still all very important. Who raises the children? I mean, this goes back to whether you have kids or grandkids and other documents too. Most people don't know this, but when kids go off to school at the age of, say, 17 or 18, God forbid something happens to them, they're in the hospital, you rush into the university hospital and say, what's going on? They say, we can't tell you. I don't know if you guys know that. Those are documents you need to have in place. That's under HIPAA law. That's the reality. You should have that on your parents. You should have that on your spouse. It's really, really important. So again, estate planning and estate tax are two very different things. And I think they get lumped together all too much. So for businesses, so corporate tax, we know that's been reduced now to 21%. It used to be at the highest tax bracket, 39, almost 40%. That's positive. The repatriation, there's this one-time event that these corporations can bring the money back that's been overseas and pay, say, about 15% on their cash, 8% on their assets. You start thinking about what this looks like and maybe why the rally up until a couple of days ago was so powerful. Maybe this had something to do with it. You have companies like Apple and Eli Lilly. Apple's got almost $300 billion in assets overseas. To bring those over makes a lot of sense. And then there's, again, the ability to go ahead and invest in businesses and have that deduction schedule. I mean, you're depreciating 100% right away for the next up until 2026. So there's a sliding scale, but that's really interesting and important. You've likely heard about this, the pass-through entities. You're able to deduct 20% if you have a pass-through entity. There are limitations here. So first of all, you can't do this if you're a C Corp. So if you're a trust, you're a state, you're sole proprietorship, you're an S Corp, partnership, you may be able to take that deduction. So that's sort of the first hurdle. You can't do it if you're a C Corp. But certain service providers, you're not able to take those deductions. So if you're a doctor, you're a financial advisor, there's a whole list of these in the code. But basically what it's saying is you're not able to take these, and you have a phase out, which is another limitation. If you're single, of close to 160,000, and if you're joint, about 315. Now the reality is if you're making below these thresholds, and you have this type of entity that qualifies, you can take that deduction of 20%. And again, that's substantial. So that's something to think about. So just a quick walkthrough on what's temporary, the individual income tax, everything got individual income tax, standard deduction increase, the AMT exemptions and phase outs, expanded child tax credits, the estate tax deduction, qualified business, the 26% deduction, and all itemized deductions except for medical expenses. There is something here under the asset expensing that's in 2026, but the medical expenses is only through the end of the year. Another question that comes up quite a bit, by the way, is, do I need to do anything this year for filing purposes in 2027? This all applies to the year 2018. So the short answer is no. But what's permanent is the corporate tax rate, AMT, repeal the Section 1031 and so forth. We talked about the exchanges and alimony. So those are some of the things that are temporary and permanent. And real briefly, because I know in time we're running close here, takeaways to consider. Review your 2017 return and have a projection run for 2018. I think that's really important to get an understanding of where you are. It'll give you ideas and thoughts on what you should be thinking about today, because everyone's going to be different. Review your withholding. If you are still working and earning an income, you may be paying less in taxes. So if your withholding is still at the same threshold, you're probably looking at a large refund. Some people like a large refund. Other people would say you're kind of prepaying your taxes and there's no reason to do that. So review that. If you're a business owner right now, have a conversation with your tax consultant. That's really important to see if you qualify. Maybe you don't qualify today and you're thinking about reincorporating your business so you do qualify, or taking certain tax strategies that you can take advantage of that. Don't let the tax tail wag the dog, but that could be interesting and potentially save you a good deal of money. From the estate tax perspective, take advantage over the next 8 years. If you don't have estate planning in place, please speak to a wealth advisor. 529s, we talked about that. Again, that's estate savings plans and the advantages they have with the new tax law and doing something before college, as well as taking advantage of the state tax deductions. Again, you're limited on your deductions now under the tax law in certain aspects. If you're not investing in some of these estate plans for children, if that's of interest to you, take advantage of that. Like I said, I know both Kansas and Missouri offer that deduction. Roth accounts, real simple. A lot of people have their money in tax-deferred accounts. You may want to consider, if the taxes have gone down for you, you may want to consider about taking advantage of Roth accounts, which don't grow tax-deferred. These are IRAs and 401ks. These actually grow tax-free. And when you're in retirement and you're in your later stages, it's a nice idea to be able to withdraw income that may be tax-free as opposed to all taxable. So you can manipulate your taxes in a very efficient way. In investments, it's asset allocation. Here, it's tax diversification. So different things to think about and gives you opportunities. So you can convert to a Roth IRA regardless of how much money you make. So that's a misnomer. Charitable qualified deduction, real quick. If you are taking the required minimum distribution at 7.5 from your IRAs and other types of investments, types of retirement investments, and you're making charitable contributions, think about the qualified charitable deduction basically it enables you to take out $100,000, double that if you're married. That money can go right to the charity, not count against you for AGI purposes. And remember I told you that your deduction is limited to charity? This is a nice strategy where your deduction will not be limited in that sense. You're actually taking that deduction, it's going right out to charity. It's a nice workaround. I don't want to say it's a loophole, but the government is still trying to enable you to give money to charity. Bunching up deductions like we talked about. And this is a little out there for some of you perhaps, but it's establishing a new domicile. So again, you can only have one domicile. You can have 10 different homes, 100 different houses, but that's just something to think about. And I think you're going to see this with wealthy individuals across the country, even those that are still working. Because today in our environment, you can probably live and work in different states, taking advantage of that. So in the Northeast, a lot of people will try and get domiciled in Florida because they stay there for a certain period of time, and they don't pay any income taxes in Florida. So that's the advantage. And obviously Texas here, it's another one, but different things to be thinking about if you're thinking about relocating, retiring. Anyway, it might be an option.